Welcome back to the news at noon. It's time once again to focus on your money. It's Wealth Wednesday here on Chat TV. Here's Chris Brown with Brian Widmer from TD Wealth.
Thanks, Dan, and thanks, Brian, for joining me again in December in the middle of a busy Christmas season for everybody.
Yeah, sure. Thanks for having us.
So the Bank of Canada raised interest rates again last week. So what is the impact of that on people's portfolios?
Yeah, again, right? So they raised the rate 0.5% last week. That takes the overnight lending rate to 4.25%, which is a far cry from the near zero a year ago. The central bank is doing this so that we can curb inflation a bit and try to slow this rate of increase of prices of everything that we're trying to buy every day. But this rapid increase in rates does cause some pain for a fixed income investor, like a bondholder. You know, at one point this year, Canadian bonds were down almost over 15%. Today, they're still down about 10%, and many bonds are trading far below their maturity values. It's been a very large decline, even from a historic perspective. But there's some good news, I guess, is the bond market doesn't expect a repeat in 2023.
Okay, so you mentioned there that this has been a tough year for fixed income investors, but if they can look ahead, is there opportunity in them looking ahead?
Yeah, I think anytime you see such a significant fall in values, it's very possible that we see, you know, at least a partial undoing of that damage done moving into the new year. This time last year, bond markets were predicting a long-term return of a couple percent, less than that. Now we're looking at close to 5% for long-term predictions. You know, if we experience a more severe economic slowdown than they're intending, we could see a rush to safe investments like bonds and have some pretty sizable returns for those secure investments. For the first time in quite a while, bonds are actually looking like a decent alternative to a more risky asset like a stock. But I should say that while bonds are safer than stocks, they're not immune to moves in the value, and they're just not as straightforward as something like a GIC or a guaranteed investment certificate.
How do those two things, bonds and GICs, compare from a potential return perspective?
Well, I mean, I'll get into the return perspective after, but the great thing about a GIC is you get exactly what you expect. Every time you open your statement, you're going to see a market value that equals the amount of money you've put in, and you know exactly what interest rate you're going to earn on that investment. But the downside to a GIC versus a bond is that you're locked in until maturity. So if you want access to some of those funds along the way, you may not be able to unless you have a very good reason. Right now, you asked about the returns. They're pretty similar. Bonds may be slightly higher, pretty similar, but bonds do offer some benefits that GICs don't. One that is, when we enter major recessions, we often see government bonds especially rise in value. And that's because people are selling their riskier assets like stocks to buy something more secure at the start of those recessions. If we see a major recession coming forward, it's not impossible to see double-digit returns from a bond, whereas today GICs are yielding somewhere in that 4.5% to 5%. Another benefit, though, to a bond is that it can be sold prior to maturity. So if we see, for example, bank shares sell off significantly, a bond investor has the option that they could sell their safe investments, their bonds, to buy these dividend-paying bank stocks at a much lower price than they trade today. A GIC investor just doesn't have that flexibility. But the downside to that is, you know, flexibility is just one decision. Investors have to think about how much risk they're comfortable taking and how this fits into their overall portfolio. And that's a conversation they should likely have with their investment advisor before making any permanent decision.
Great. Well, that's a lot for a lot of people to think about when it comes to their investments. Thanks very much.
Yeah, thank you for having me.
All right.